You all getting any of this snow down your way at this point or no?
Getting the weird stuff.
Yeah, it rained all day yesterday. We got about 3 inches, and then it iced over, and now it's snowing on top of the ice and freezing. So yeah, and then we're gonna get more snow. So it's gonna be pretty bad.
Getting the best of all worlds, huh?
Right. Well, that's St. Louis. You wait 15 minutes. Now it was 70 degrees. 60,
Yesterday.
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 So that's how we roll in St. Louis.
St. Louis is bipolar.
Amen. Amen.
Can you give me my water? Thank you. I had a grandson that turned 32 yesterday.
Oh, wow.
Mm-hmm.
Congratulations.
Yeah.
Yeah, congratulations to him.
Oh, well, congratulations on having a grandson to turn that age, because these young kids nowadays, I tell you, it's
They don't have the evil grandmother as me.
I see.
32 is the new 18, isn't it?
Amen.
You know what? Yeah, if you was my Facebook friend, you would see my grandson does look very, very young, but he's 32.
I see.
All right, well, we have Christina. We have
Can you close the door?
enough to get started whenever you all are ready.
Okay.
Hold on, I'm coming. Sorry. You said,
No worries.
Christina, I stepped away to go get my soda, but then I'm like, okay, let me start this. Sorry. I should have left my video on so you could see I stepped away from the desk.
Okay.
All right, Sue, are we ready?
We are ready when you are.
Good afternoon, everyone. I hope everyone is safe. Guelda, we're having an ice storm at the moment. So it is very ugly outside, but hopefully everyone's indoors warm and ready to take us through this meeting and not having to have anybody drive home or try to get home. Students were out today, so that was a good thing. Welcome everyone to today's investment meeting for February 17th, our monthly investment meeting. Today we're gonna talk about our flash, correct, Welda?
I think we're going to do the quarterly first and then.
Okay.
Yeah.
We'll do the quarterly first. We'll go through the flash, and if time permits, we'll do some high-level discussions on the changes in the investment guidelines. But I just sent an email out to Sue on that. So if we have time, we will go ahead and do that.
Okay.
So I'd like to call the meeting to order at 4:33 p.m. Sue, can I get a roll call vote, please?
Angela Banks,
Here.
Christina Bennett,
Present.
Lewis Cross,
Present.
Sheila Goodwin,
Here.
Donna Jones,
Here.
Yvette Levy, Bobby Richardson, Albert Sanders,
Here.
Justin Stein,
Here.
Doris Walker.
Here.
All right. So we have 8, so we do have a quorum.
Thanks. All right, let's go ahead and jump into the quarterly report. Guelda and Jeff, the
Okay.
floor is yours.
Okay. Susan, are you sharing or you want me to share?
I have it up.
Got it? Okay, perfect. Okay. If you'll go ahead and skip to page 14, I'm going to talk while she's doing that. First off, good evening to everybody, and thank you so much for having confidence in us and ANCO as a firm. Wanted to let you know that we are continuing in our focus of being independent, and we are investing 100% of our profits back into the firm. in the areas of research and our IT department. We're continuing to beef up our staff in the alternatives areas, as well as in performance measurement. We recognize that a lot of the funds are allocating more and more assets to the private areas. So we are continuing to add to our staff. We have about 90 people now and about 15 in the research area, and a significant growth in the private asset area. So just wanted to say that. Just wanted to say that, and thank you all very much for selecting us as your consultant. And we're gonna walk through this first report primarily to give you an idea of how we have it laid out. We'd like your feedback on how it's laid out, as well as the content, to make sure we're bringing to you something that helps you as fiduciaries. I'm not going to spend a whole lot of time, just make a couple comments just to remind you of the market environment in the fourth quarter of last year. As you know, domestic equities did extremely well. The international markets, equity market, not quite as well, but they were also positive. The one area international, or I should say outside of the US, that was very weak was emerging markets, and you'll see that in the results here. Fixed income was tough. Interest rates rose, inflation, and as a result, you will see muted returns in fixed income, and over the past year, negative returns. So with that being said, the first part of the report is pages 1 through 13 is the market overview, et cetera. This is the actual first page of the report where we actually get into the meat of your fund. And this is an asset allocation page that we put together every quarter. And going forward, also in the flash report, we will start putting this in from 1 month to the next so you can see. As you can see here on this page, the little triangle, black triangle, or the red triangle, upside down triangle, represents where you are in that particular asset class. The bold line, vertical line, is where the target is for this particular segment of the market. And then the gray bar represents the upper and lower range. So to the left is the lowest and to the right is the highest range. So as you can see here, there's a red upside down triangle in large cap equity, which means that you're over allocated outside of the target range. If you look down on the chart below, you'll see that the target is 13 and the maximum target is 16, and you're at that maximum allocation as of the end of December at 16%. Now, this may look very different when we go forward, because as you know, in the equity markets in January, and Jeff will go over that, took a significant hit. We've had a lot of angst in the markets in the month of January. Other than that, the other areas there, some are slightly off, but they're within the range. With the areas where the targets are off the most would be in international equity. You see here, it's below target in international equity. If you look down below, your current is 11, the target is 14. If you look down further into this, you'll see that emerging markets equity, which might have been a plus because this particular time frame, emerging markets has not done well. It's under allocated at 5.6 and the target is 8, and that's the next largest. And other than that, the alternative investments, which is not unusual for alternative investments to be a little under, because you're constantly getting money back. So you're having to constantly fund up to get to that target. But I'm thinking with the commitments that were made in the fourth quarter, once those things are fulfilled, your alternatives target will be more in line with where it should be. So that's the first page that we typically will show, because asset allocation, as you know, is one of the primary determinants of what your long-term performance will be in the fund. If you turn to the next page.
So Gwilda, can we go back really quick?
Sure, go back.
Since this is all new to us and we've never seen any type of performance with this model, I really like it because we can look at the bars and more people are visual and they can see where we are.
Yeah.
So when you have your asset classes up top, so for example, absolute return fixed income, right? So we know the names in our portfolio, but not everybody knows, like, what does that really mean and which managers does that really impact, right? So if sometime in our next meeting,
Mhm.
just if it would be helpful to put in parentheses, maybe at the bottom, just for, for, until we get used to it, that, which manager is in, we know which ones are in equity, right? Because in one of the boxes you tell us, but we don't know when it comes to core fixed income, absolute
Okay.
fixed income.
Okay.
I think that would help us, help the team, really get a better handle, so that when we start looking at this, this top chart, we're going to actually think in our mind which managers those refer to.
Okay.
But it would just help us on a learning scale for other trustees. And if anybody else doesn't, has any comments, please let me know. But again, as we start to look at new reports and styles, just getting us used to looking at it and knowing the names a little bit better would be
Okay.
helpful for all of us.
Absolutely. Sure, we can do that. Okay. Any other questions or comments on that page? Otherwise, we'll go to the next page. This is, if you can, there you go. As you can see here, this is color coded by the different parts of the market. This shows the difference between September 30 allocations by different areas of the fund and where you are as of the end of December. It also shows the growth in the fund from September, the market value, which is at the top. As you can see, in September, the fund had 928,189,831. And then you had growth. So in December, 963,988,567. So you had significant growth in the fund from September to December. So this basically just, and these at the bottom allocate to, and I guess once we have the legend on the prior page, you'll be able to better tell who's in each one of these color-coded boxes going forward. So that's just the asset allocation in a graphic way of showing the different parts of the market that you're invested in. You can turn to the next page. This is a fee schedule. I know that you have not been accustomed to seeing a fee schedule in your report. This is something that we incorporate into all of our reports. So you kind of see what you're paying each of the managers. On the left-hand side, you see the names of the managers outlined. You see the fee, the estimated fee, which is based off of that last column, which says fee schedule based on the assets that you have. So we basically just take the market value and apply the fee schedule to the far right column and come up with your fee, which is your estimated annual fee percentage. Now, the actual dollars that you pay on an annual basis is the next to the last column. It tells you the actual dollars. That's not what you pay per quarter. That's the whole annual fee. So you could basically divide it by 4 and come up with approximately what you're paying on a quarterly basis. Now,
Gwilda, I have a question for you. So
Sure.
for example, we have a lot of managers in our portfolio that have been with us 15, 20 years.
Right.
So that means that for the last 15 to 20 years, no one has ever picked up the phone to say, you know what, that was 15 years ago pricing, but there's no way in hell that you're going to get a client right now that is at 75 basis points for the first 10 million.
Right.
I mean, so.
Oh, shit.
Oh, sorry, Doris. Was that you?
Okay.
So-
Okay, Doris.
So I just wanted to think about that. Like,
Right.
when you look at, PIMCO All Asset Fund, when we got them, I have to say 2004, 2005,
Yeah.
no, maybe 2006. I'm going from memory. And when we hired Causeway, it was around that same time frame.
Yeah.
Some of these big ones that are at 75 basis points, and 1%, that's not today's pricing.
Right, exactly. And I was going to say, we actually were able to get our, it was done after the printing of the report or the compilation of the report. We actually have an updated one of these that will be going forward. I don't know if Sue has it available. She could pop it up on the screen, but actually we have another column in between the estimated annual fee and the peer average. I don't know if she can pull that up or not.
That's the one you just sent me.
Yeah, the one that has the column that has.
Okay. All right, I got it.
Okay. You could put that up on the screen. And this will be the updated one that you'll see in the reports going forward that she's pulling up. Okay, as you can see here, we've got the peer average annual fee next to these managers.
Right.
And so you can see, okay, this is what the average annual fee for this particular asset class at this asset level is. And where we have the highlight, you see the yellow highlight, those are the ones that Jeff and I looked at that they're over. What is the average annual fee for that particular style of management and the dollar figure? And that's what we say there's room for negotiation to go back to those managers and say, look, you're a little bit over. We would like to a fee concession here. So this is something that we will have in every report going forward, and we'll work towards bringing those fees down. If you can scroll it just a little bit, Sue, we'll see what the
Yeah.
you see some of those, like for systematic, that's significantly more. PIMCO, like you said, the PIMCO All Asset Fund, the large cap growth, we know our large cap growth managers are typically around 50 basis points, so they're over. And these are like you said, Christina, this is due to contracts that have been around for quite some time. Yeah, so we're looking to not only make you aware, but also see if we can save on investment management fees going forward.
Okay.
Wonderful. I really like this concept. I like, being able to see what the, in our packets, we do get like a fee structure at the end. But by the time you get to the end of the book, I'm not sure any of us are looking at in detail and backing into what the basis points are.
Right. And that's why we decided to put it up in the front of the book so that it's something we know it's a focus and it's something that needs to be addressed on a pretty early on in the report. Because we do monthly flashes, so you kind of know where the managers are anyway, but this kind of information, you only see it periodically. So we put it up in the front of the report, having listened to your feedback on wanting to see the fees.
Mm-hmm.
Okay. Any other questions on this? We can go back to the report. So.
It's the flash. Oh, sorry. That's
okay. No, that's a flash.
That's the monthly one.
Yeah. Sorry.
It's way over here. Okay.
Okay, and go past that page. We'll go on to page 18. This is the Minority Brokerage Commission page that we put up in the front because we know this is something that is important to the board. And this actually, these commission goals or percentages in the blue bars are what is from your investment policy document, and the goals for each of the different types of investments. So you can see here the goal for domestic equity is 33%. And you see the managers that have actually reported and participating dollar figures for 2021. And then the amount that was actually MWDBE commissions and the percentage of the commissions that represents their total for the year. You see this for the different asset classes. As you can see here, quite a few managers are not participating or not reporting their minority brokerage. So what we are planning on doing is, in addition to the brokerage, minority brokerage, we are going to work with Sue to put together a letter because it is in your investment policy document, what the desire is for the different asset classes for each of the managers, a minority participation in their commissions, but something that is not in your investment policy, but we also have noted that some of your managers are participating in is a commission recapture program with State Street. That is not in your policy, and what we always encourage a specs execution, but when there is room for commission recapture, we like the managers to do the commission recapture. So we're going to put together a letter that is a combination of addressing this brokerage, NWDBE brokerage commission goal, as well as when it makes sense, when it's, because a lot of things are trading out at very, very low commissions, but when there is a room for commission recapture, we want the managers to work with State Street since that program is already in place for the fund. So that was the next page in the report. Any questions on this or
Yeah.
comments?
So Gwilda, if you go back to our December 31, 2020 report,
Mhm.
most of our managers comply. So TCW, they have been hot and cold on this policy.
Okay,
How we got their attention in the past is we put them on watch list.
okay,
And we actually, at one point, terminated Causeway because they failed to do it. And we actually took a vote and told them that we were going to terminate it. And then NEPC came back and got them to agree to comply
okay,
with this MBEW. So we gave them a second chance, and they've obviously, I see they've complied this year, but they've been better. But TCW has been one that they have not done well in compliance. So if we give them till next month to comply with the December to submit the reports, but at this moment, if that's in our guidelines and they haven't done it, to me, those that did not report should be on watch for that purpose. I mean, that's our guidelines.
okay,
And this isn't anything new. The state of Illinois has it. The state of New York has it. So they're just choosing not to submit the report at this point, and changing consultants should not be the reason they don't submit this information.
okay. All right.
But
Right.
I'll let other people comment on it, but to get from all the managers that we have, especially to get this small amount reporting is unacceptable. And we've got 4 minority managers that are on this list, and only 1, 2, 3 majority firms that are reporting is unacceptable.
Right, and I think you make a good point regarding a change in consultant, but I think that also is it just gives us an opportunity to have a refresher, again, as Gwilda said, to put together correspondence that says, we have a policy that has these requirements in the policy, and then that as Gwilda said, we can also fold in that there is a commission recapture program that's available. And again, not forcing anyone's hand on that one, but this is in the policy. This is important. But then to have documentation, number one, to say that we sent out a fresh round to everyone to remind them of this policy, but then also to get responses and to have that in writing for documentation. So with respect to TCW, that's interesting that you mentioned that. Have they given the board anything in writing that says this is why we're not complying with the program, or this is why we're not participating?
No, they've participated in the past. And Sue, if you can look and see what they did last year, but I was going to try to pull it up. I didn't have, I'm on my computer now, so but I can look up, but Sue can look it up faster on what we did last year. Causeway just didn't want to do it, period. And that was probably like 4 or 5 years ago, Louis. But but they've stepped up to the plate this 21, 20, I mean, maybe 18 or 19, they didn't want to do it. TCW just said that I think they are more of a quantitative shop. And so they're like, we're just not interested, we'll try. But I think last year they did meet it. So it's surprising that they're not on here. I'm trying to think who else. But most of them did comply last year.
Okay.
I don't think we put anybody on watch list from last year's compliance.
Okay.
Again, these are the things it took us a very long time to get this program in place, and it's very important to us. So to not have compliance is a disrespect to our guidelines and our efforts of what we've done for MBEWBE.
Sure, no, fully understood. And again, I think that's from a documentation standpoint, again, to give them something in writing that says that this is a reminder, number one, and you are to comply because it's in the policy, but then also to require that they, if they're not going to, that they give us something in writing. And again, I think part of that correspondence too is just saying, as you said, Christina, and if you're not complying, you will be put on watch. So.
Well, I mean, a watch and or termination. I think no one wants to lose AUM at the moment. And for something that is so small that it's easily doable in a couple of trades with some of these. I mean, when you think about it, like, Systematic Financial, it's only $1,200. I mean, granted, they only had commissions of $6,800, but it's simple. It's just not wanting to do it in the notion that they can't get best execution is maybe worked 20 years ago, but not in today's technological environment. A minority manager is not going to give you something less that another firm can give you.
And maybe what we'll do is include in the letter that, this is part of the investment policy document and this is grounds for watch and possible termination.
Absolutely. Well, let me hear from the rest of the board. I'm sorry, I'm monopolizing.
Well, I just wanted to throw in last year's report as of 12/31/20. I don't see TCW listed on that report either.
You're on mute, Christina.
That's 2 years in a row now.
Well, I'm all in for it. I think the letter is appropriate, and I think we should get it out to each and every last one of the folks who are not in compliance. And also the firms that are charging high percentages. Are we going to also send something to them, or are we going to do that a little later? Sue and Christina and Al, Welda and Jeff, are we going to do that later? Or are we going to send that out at the same time?
Jeff, I think Jeff and I need to talk about it, but we need to look at try to renegotiate fees on all the ones who are over. We'll have to come back with a plan on that.
Okay, that's great.
And I do want to caveat on that fee page as well that I from a negotiation standpoint, with any manager that has a separate account, so those will be all the managers that you saw that have those tiered fees by asset level. Those are the managed accounts. Those are probably going to have the most success in negotiating a fee. The ones that just have one single percentage of assets, those are usually going to correlate to a fund. And for someone that's a fund, we're going to be in the lowest cost share class of that fund. So that's going to come down to a factor of, okay, do we like PIMCO all asset period at this fee? We know it's a higher fee. Do we like it? Are they adding value after fees? Because we're not going to be able to negotiate a better fee. And I think that's going to be a discussion for the next couple of meetings as we go through some of these managers and strategies and say, we think this is a good strategy net of fees, or we don't, and this might be a better place to deploy capital. So just a bit of a caveat on that fee. By and large, most of them are managed accounts, so there should be some room on those. But a couple that are funds, the decision point is going to be, do we like the fund or not? So
sounds good.
And I think, Jeff, the great thing is to give you the flexibility and Guelda to go and negotiate or renegotiate some of this. But also in conversations I've had with other board members is this is also a good time to say, like you had recommended, like, do we really need, if we have the highest priced manager X in this asset class, do we really need it? Right. And is it complementary once you give us a correlation report that says, we might not need somebody that's at 1 basis points or 75 because the other two are doing just as equally as well. Right. So I guess these are going to be all working conversations going forward until we really get to the portfolio recommendations instituted and paring down if and when we need to.
Once we go through the asset allocation discussion, the manager structure will better, be in a better place to determine, okay, what's left and are there fee negotiations that make sense. Yeah. Okay.
Sue, can you tell me the date of that report? I'm trying to find it on my email.
So we did that at the February of 2021.
Okay, I'll look at it. Yep, I'll look at it. Thank you.
That's what I have a question. This is Justin.
The brokerage fee for the minority brokerage commission goal, and when do they have to report these percentages? Is this on a quarterly basis or a yearly basis? Or is there a deadline for everybody to report at the same time?
Well, typically we measure them at the end of the year since it's a yearly goal, right? It would be wonderful if they could meet it in, sooner rather than later, but they're measured by the end of the year. So it's not like we're really putting pressure on them to get this done in a short period. We give them 12 months to comply with these goals, and we measure them for the December report. And so it's not that difficult. They'll tell you that it's difficult, but it really isn't. It's simple as instead of, calling, one phone line, you call another one to get it done.
Okay. This
But
is
it's yearly. Yeah, it's yearly.
yearly at the end of December.
Mm-hmm.
Okay. All right.
I do agree that we need to, I like the letter idea, because if it's part of our policy, it's part of our policy.
Mhm.
I mean, that's the basic thing. If it's part of the policy, then we should follow up and they should comply with our policy.
Okay, all righty. Are there any more questions, discussion on this? If not, we'll move forward to the next page. This is what you all probably seen before. Financial reconciliation basically shows the flows amongst all the different managers from October 1, which is the beginning of the quarter, until the end of the quarter, December quarter. So you can see contributions, distributions, the net flows between those two, and the capital gain or loss or increase or decrease in market value by manager to end up with the market value for each manager as of 12/31. That's page 19, and that's the quarterly flows. And then page 20, which is the next page, is the annual flows, just the 1 year flows. So those pages are the next pages in the report. No questions there. Let's go to page 21.
Hold on, Gwilda, I want to go back to 20, just because we're still all learning this new process, just to get everybody, when we look at, like, if somebody says, ask you the question, because we have 7 elected trustees, they ask of, what's your portfolio? These two last columns are really big, just because we never really know what the percentage return is for the year. It's, if most people ask a question, it's what's the balance in your investment pool? And this is a really good page. That's a snapshot that tells us we're at 900, and is that 63? Ooh, I can't
Yes,
get on.
963 million.
963 million. And for the year, we had 104 million gain. I mean, that's pretty, those are number where you can even round it and say we had $100 million of gain.
Yeah.
Right. This won't always be this high, but this is a really good number for us to know. And at some point we'll look at that return number for the year, but these are good numbers. And then always the next question they ask is, well, how much did you pay in benefits? So these, if those 3 numbers that trustees can remember, I think that's going to be critical for us. I don't interact with many retirees, but for those that do, this is where, we should be looking at this one pager if you ever have to look at a page. Thanks, Gwilda.
You're welcome. The next page is page 21. You can scroll up just a little bit so they can see, and maybe it might make it a little larger because I know these numbers are little. So this is where we do peer group comparison. Go back one page, go back. Yeah, here we are. The peer group comparison, and this is how your fund looks versus other public funds that are slightly below $1 billion. As you can see here, the ranking is not really all that great. But what Jeff and I have realized is this is comparing you to, I think, a subset of funds that we think maybe not as comparable. You're basically at $1 billion. So we're looking at putting you in a universe of funds that have alternative investments in it. which will show differently. And in addition to that on here, the private investments, as you all know, have a quarter lag. When I say a quarter lag is they don't report as timely as your public investments. So those numbers are not included here in your composite. And we would venture to say that your composite return is probably going to be a little higher. Fourth quarter actually, and last year was actually a good year for a lot of the private investments. So we would expect the composite number here showing would be higher than what we're than the returns that you're seeing here for the quarter at 3.01 and the year at 11.57. We expect that number to go up. Do you all understand? Let me say, do you understand what the bars represent, or no? And the little numbers in the parentheses? No. Okay. So the bars represent the upper and lower range of returns, which is shown in that bottom part of the graph. You see 5th percentile down to 95th percentile. So for instance, in that first column, the top, as you can see, is of that blue bar is approximately 6. And the bottom of the bar, which says 0.05, that's what that bar represents. The median is the average or the middle of the road. And what you always want to see is your blue dot, which is the fund, total fund, above that median or that middle range, that 4.9 in that case. So as a result, you see your return for the quarter was 3.01 and the median was 4.09. So you all have fallen below median and actually in that bottom, the bottom of that bottom box. So what we're trying to do over time is to get your fund above that median range versus other funds that invest like you. So we're going to look at, like I said, changing the universe that we're measuring you against. And then once all the private returns come in, we should see these numbers change and go up. Okay.
Okay, because you just scared me because we're below. Our blue dots are all below.
Yeah, yeah.
So I'm like, okay, I can see pictures here. Now I know what it means and how to read it.
Yeah.
But our blue dots are all below the
mid-range.
The mid-range.
With the exception of since inception.
Right. But since inception is
that's
like
a long time
my
ago.
grandma's age, right?
That's a long time ago.
So
a long time ago. You want the number, you want that number in the parentheses next to your fund return, which is the composite. You want that number to be below 50. So anywhere from 1 to 49 is what you're running for. Anything below the number 50 is not good.
Okay, well that puts it in perspective because we always think that higher is better, right? So in this graph, lower is better.
Lower, yeah, the lower number between 1 and 50 is best.
Okay.
You always want to be.
You might want to flip that note for us until we get used to this chart and see the little dots move over time.
Okay. All right.
And I will throw in there too that Gwilda made a very, very important distinction on this from a universe perspective, in that these are measuring you relative to a universe of plans that are less than $1 billion. Mm-hmm. And by and large, many of the plans below $1 billion don't have a structure that's as sophisticated as yours. So mm-hmm. they might not be using any alternative investments and might be doing other things. And I think that's going to skew this universe. So again, our thoughts, and we want to take a look at the numbers, that you really should be in a full universe of everyone. And that includes the bigger multi-billion-dollar funds, because that's really how your assets are deployed, like a sophisticated multi-billion-dollar plan. And those are going to be plans that have more alternatives and other items in it that are, and again, offering great diversification, but are also going to look a little different in these universe rankings. And again, we don't have the numbers in front of us to tell us how that shakes out, but we suspect that's going to push your ranking better in the universe, in the overall universe. And it is just a better apples to apples comparison.
And the other thing too, on that note, is that For those funds that don't have the asset allocation as you all have, they probably have a tendency to have more of domestic equity, a larger percentage. As you know, domestic equity has outperformed significantly. So the returns here might be a little, on the higher side because of that.
So, well, the question, go ahead. Go
Question.
ahead, Sheila.
What's driving these returns?
How you're allocated and your manager performance, a combination. How you're allocated in different asset classes or different parts of the market and the managers that you employ. The composite is just the roll-up return of all those managers' returns.
So, Gwilda, question for you. If we're at the top end of our universe, right? Because we're at 963 and in the top of the bar is at $1 billion. What's the next category?
Billion, over $1 billion.
Just so it's under $1 billion or over $1 billion. It's not like
we have
5 billion or
we do. I have to look at the actual breakdowns, but we do have an all public funds universe, which is more inclusive. This one is probably, it says, like we can see here, the population in the universe for the quarter was 312 different funds in here. If we do the all funds, it's going to be a much, much larger universe and a much more diverse universe. So,
yeah, I just didn't know if we go to like under 5 billion universe, because we don't want to be competing against the CalSTRS and CalPERS, right? Or university endowments that have,
large. Yeah, you wouldn't be in the endowment. That's a whole different.
Oh,
universe.
okay. That's a whole different universe.
It will be public funds. We just need to see if there's I don't know, Jeff, there's a breakdown. We'll look at the next level of universe comparisons and make sure you're in a more appropriate universe.
Oh, I see. Population is 312. Okay.
Yeah, at the bottom, that tells you how many observations there are in those particular time periods.
How would the current environment impact future returns?
We can't say into a crystal ball. I would say that the current market environment, the fixed income managers are going to have to be very skilled with inflation as well as interest rates rising. So that's gonna impact your fixed income portfolios. I think we have been somewhat spoiled, especially over the last year. We've seen double-digit equity returns, which I think is I don't want to say it won't happen, but that is not the average or the norm to have those types of returns in the equity markets. So you will have to see how it shakes loose, but right now, the managers, I think, are going to have to be very skilled going forward. Jeff, if you'd like to add something to that comment.
No, I think that makes a lot of sense, Gwilda, and I think we're going to see a lot of volatility, and we've already seen it. And I'll cover this a little bit when we talk about the January flash report, because you will see the start of that volatility, but certainly. Inflation is a big concern, and that's translating into what the Fed is thinking about doing with interest rates. And now we have this conflict between Russia and Ukraine, bringing a lot of volatility to the markets. And generally, and again, it's not to say what we did in the past we're going to do in the future, but in the past, when we've seen the Fed start to think about getting a little bit more aggressive with interest rates, and then the market takes a hit for one reason or another, they start to soften up language. And so they could very much take a quick turn on the policy that they've now been telegraphing for the past several weeks, which is that they're going to be more aggressive on rates. And we could also very quickly potentially see some change in that inflation number too. So I know we saw a fairly a weaker employment number come out that's now starting to reflect, I think, what we all suspected, that after we got through the first of the year and a lot of the stimulus that was in place to get us through COVID, as that starts to roll off, well, those that didn't want to work and that weren't necessarily making the unemployment rolls in the figures just because they weren't in the workforce, well, those individuals are now starting to run out of cash. And we've had great spending for the past year, for the past couple of years, consumer spending that had money in their pockets. But now that that's starting to go away, I think we're getting that wake up effect of, hey, I think we need to now go get back to work. And I think a lot of that's going to result probably in spending coming down somewhat. Employment numbers are going to stay strong, but as Gwilda said, the double-digit returns that we've seen of the past couple of years, those are just not going to be as realistic given some of the headwinds that we have.
Well, you mentioned that the universe is going to mention how the universe is going to impact the returns and the environment, etc. What makes up the universe?
This particular universe is for funds, public funds of less than $1 billion. And while we're saying that we think that a more appropriate universe would be funds of a larger level, a lot of the funds in this particular universe don't have private investments in it. A lot of them probably are more skewed towards domestic equity, domestic fixed income, probably some international. But at smaller funds that are significantly lower than yours, I mean, you're looking at funds probably near from $25 million up to $1 billion. And those funds would not have the sophistication of asset allocation that you have. So as a result, a lot of them are going to be heavily skewed towards domestic equity, which should make these returns a little higher with the performance that we've seen in domestic equity. When you look at the alternative asset classes, you don't see, in some cases you do, but hedge funds, you wouldn't see these kind of returns in hedge funds because that's not the goal of a hedge fund. So, we think that changing the universe, it will be more in a group of funds, other public funds that look more like you as far as the asset allocation is concerned, or how you're allocated. So we're hoping that it will show better, it'll be more appropriate, better fit. And also, as I mentioned to you all, you have to look at this and take into account that this is not including some of the returns in your private assets because they have not reported for the fourth quarter yet. They typically lag by 3 months in their reporting, the private assets, which would be your private debt, private equity, and some of your real estate.
Okay, thank you.
You're welcome.
I have another question too. The universe that you have us in right now at just under $1 billion.
Yes.
We had on the other pages, our accounts, there were like 40 different investments, right?
Yeah.
Is that according to like with our peers in that universe, or is that pretty typical to have that amount of diversification?
Okay, when you talk about diversification is one thing, and number of managers is another thing. Diversification by asset class, for funds over $1 billion, you would see that kind of diversification. But I would venture to say you might not have quite as many managers as you all have. You do have quite a few managers, and there's some duplications. And that's one of the things that Jeff and I will be addressing when we look at the manager structure.
All right, thanks.
You're welcome.
Okay, the examples that you would provide about the clogging of the public funds that you're considering, are these funds, how funded or underfunded are these funds?
I wouldn't be able to tell you that. I don't know those statistics.
So Sheila, out of the 312 pension plans that are in our portfolio, that are in this, what we call the grouping, our population, they could be anywhere in the US. They could be small funds from 25 million up to similar to ours for $1 billion. So, about 15 years ago, we were still sitting at 400 million. So we looked pretty darn good because we were so diversified and we had so many managers that we looked really good in comparison. But as we've grown and we still have it, so I consider this that we are a big fish in a little pond, where if we go to a bigger pool, we're going to be a small fish in a big pond. And so, so while we will have lots of similar managers and the diversity, we won't have the assets compared to other bigger funds, but we have the same, I want to call it discipline and structure, and opportunity, right? We've done a good job, and we call ourselves a mature fund, where the population, we don't know what the defined population is. It doesn't tell you, who's in it. It's just people report to this database, and the database pulls the population of everybody's returns in there. And that's how we get these population pools. Does that help?
Yes.
Right. So we don't know the strength or wellness or healthiness of anybody in that population, only ours.
Right.
Okay.
Okay. Can you move to the page 23? So a couple pages forward, one more page forward. This is where you'll see, and you'll see this in the flash report as well. This one just, this gives you more information in the quarterly report than you do in the flash report, because you have your universe rankings here. We already talked about the composite, which is a total roll-up of the funds. And you can see what the returns were of the composite for the fourth quarter, as well as over the rolling returns. Those numbers you've seen in the flash report we did last time. The difference here is you have the universe rankings. And as we mentioned, we talked about the rankings on the prior page, where the best ranking is since inception, which is 1997. What I will say on this page is we're going to focus more in on the managers that are on watch per your watch list policy when I go through this discussion. But what I will say here is in your total domestic equity, actually, albeit the return of the segment was 8.15. It was not as great as the Russell 3000, and that could be because your fund is not allocated just as the 3000 is allocated. But with respect to other domestic equity portfolios or funds, you actually ranked above median at 44th. And over the past year, right around median at 53rd, with a return of 25.72. And as you look at over the 3-year, the 5-year, the 10-year, and since inception, you have pretty much ranked right around the median or a little bit above, with the exception of since inception, it's slightly off. But since inception, what is a good thing here is you have beat the Russell 3000 at a return of 10.5 versus 9.81. for the Russell 3000. I'm looking at that section in the middle of the page. It says total domestic equity. And then as you look down, you start seeing the managers that you have in each of the segments, like Christina mentioned on the other pages. If you look on here, you see in large cap core, you have the Mellon Stock Index Fund, and that's just the fund that replicates what the S&P does. So you expect that that's saying, okay, look, we just want to have like a anchor in the large cap portfolio for us to build other managers around that have skill in value or in growth. So as you can see here, basically you're just mimicking the index. So there's no active management there. As you can see there, the returns are almost right on top of the S&P 500 at 11% for the quarter, 28.71 for the year, and so on and so forth.
So Gwilda, does that go further into if our Mellon 6.9 million is matching pretty darn much the index and maybe beating it by a little bit?
Yeah.
Then really, do we look at it and say, why are we paying a lot more for an active manager if they're matching the index and you can get an ETF?
Okay, that's the thing. Well, that's one of the things that we determine is, okay, large cap is a very efficient area. The only reason you would actively employed managers, which you do have active managers in large cap, not in core, but you do have them in the other, style sectors, is you only want to, what makes sense is if you're going to employ active management in large cap, which is one of the most efficient areas in the market, the manager should be beating their market benchmark as well as ranking in that numbers 1 through 49 in their universe. So if you're going to pay fees, they should be outperforming the market benchmark as well as ranking well in their peer group. And that's one of the things that's in your investment policy as far as Watch is concerned, that they're supposed to meet 2 bogeys, which is beating the market benchmark as well as their ranking in the peer group. As a result, some of your managers over time have not done that, and that places on the watch list. Does that answer your question?
It does, but we didn't put them on the watch list for the double parameters. We only held them accountable to the 2-year, consecutive.
2 year. That's true.
Yeah. So again, I'll go, just for educational purposes, when we go back and look at the fee schedule and we look at what we're paying Mellon, then, again, you'll make those recommendations, but
yes,
looking at our portfolio with fresh eyes, different formatting, listening to the same story, just giving it in a different way, because I think, I'm getting a lot out of this is, right, we've got, this Mellon equity in, it's an index fund.
it's an index fund.
But we're paying a premium for us to match that.
Yeah, we that's one of the things that we will go through and look at is what makes sense where we can maybe cut back on some of the managers if they're not adding value over and above net of fees. We can look at that when we look at the manager structure and try to make this portfolio as efficient and as cost effective as possible. Because if they're not adding value over and above the market benchmark on a long-term basis, you're not getting what you're paying for. Okay. The first manager that we have on here on watch for your watch list is Edgar Lomax, and it was over a 2-year period. They had not met it. What I will say here is they are a high quality value manager, and they go through ebbs and flows. I've known this firm for a very long time. As you can see here, on the long-term basis, the rolling periods, and as you know, for each one of these rolling periods, it changes every quarter. You drop off a quarter and you add a quarter. But for the fourth quarter of 2021, they actually did well versus their benchmark, 8.95 versus 7.77, and they ranked significantly above the median at 35th. So they are improving. What we'll have to do is determine on a long-term basis going forward how much time we give them to improve performance, because you all have a 2-year rolling period performance. Typically what Jeff and I've seen is a 3-year rolling. I'm not quite sure how we came to the 2-year rolling performance numbers, but that is what is currently in your policy. If you could turn to the next page, Sue. Intech is also included on the watch list for a 2-year rolling, albeit if you look on here, Intech looks great. You got, they're right at the index, which they should be over, but they're ranking 25th versus other large cap growth managers. What you see across the board here is kind of what Christina was saying. The manager is ranking well versus other growth managers, but relative to the index, they're not outperforming the index. They're almost right on top of it or slightly below the index in all time periods measured. In addition to what we're showing here, we're gonna Jeff is going to talk a little bit more about Intech. There's some news that came out on Intech. You might have seen it in the papers, but we're going to talk about that right after the performance report is done. The next one is TCW.
TCW. Mm-hmm.
Yeah, TCW is on watch. As you can see here, TCW is on watch for the same reasons. In the fourth quarter, they did not do well. As you can see, significantly below the Russell 1000 growth. 6.43 versus 11.64 at a rank of 76 over the 1 year period. They are ranking well versus their peers, but they're below the Russell 1000 growth. Primarily, the performance in the fourth quarter was due to stock selection in information technology and some of the real estate and consumer discretionary sectors. PayPal was one of their holdings, and it represented 3.9% of the portfolio, and it was one of the top holdings, and that hurt them significantly in that segment in the fourth quarter of the year. So TCW is on watch, and we'll have to do some looking at that to see on a long-term basis if that manager is the right manager in that slot.
So Gwilda and Jeff, the question for you. So let's take, I don't know, Intech, right? It doesn't matter to me, but we have two benchmarks, right?
Right.
I've never been able to understand why we have two benchmarks. Do we need both benchmarks? I mean, they're pretty much in there. There's, not much difference between the two benchmarks, but
No.
So do we need two benchmarks?
Yeah, we're showing here the market benchmark, which is the Russell 1000 growth, and then
Right.
we're showing the peer group return, the median peer group return. So you're looking at them versus not only a market benchmark, but also versus other managers that manage in this style. And that's to say, okay, if are we doing well when we look at other managers that manage in this style? Or are we doing poorly? And that's where the little parentheses number comes from, the peer group.
Okay, so
To think about-
no,
to
but I'm
think-
talking like when we look at the Intech, the U.S. large cap growth equity SA plus CF median. So that's our peers.
That's your peers.
Okay, well that again, maybe anybody else, does that help anybody else better understand? But I think that's us, and then this is what our peers are doing. Okay.
Right. And the number in the parentheses, you can see the median was 9.33. You performed better than the median at 11.62, which gives you a rank of 25th.
Got it.
Which
Well,
is
Jeff,
great. Go ahead.
Sorry, I do want to clarify on that too with respect to peers. That's not going to be the median returns of what peer pension plans are getting in large cap
No.
growth. That's going to be that universe of all of the large cap growth active managers. So, and again, just another easy way to think about that last line or that second benchmark is if you were to put parentheses next to all those returns, they would all be 50.
Right.
So that's your median.
Okay. I will just make a real quick comment here on the small cap segment. As you can see, your small cap managers are all doing for the quarter really well versus their respective benchmarks. Westfield, Systematic, and DFA all did well and ranked above are lower than 50. So they're all doing really well. No concerns there. On a 1 year basis, Westfield slightly off versus their peer group, but you look at their numbers versus the Russell 2000 growth, they've done a really good job at 10.5 versus 2.83. The same being said for Systematic, your Russell 2000 value or small cap value manager, they've done an excellent job. And then your micro cap manager, which is DFA, they're right at median and they're significantly above their benchmark. On a long-term basis, there's a couple of blips in the road for DFA, but I don't think there's really any concern with respect to the small cap segment for us to really be concerned about. And none of those managers are on watch. If you go down to international equity, Causeway is on watch. In the fourth quarter of the year, they're continuing to struggle. Their underperformance in the fourth quarter is due to holdings in pharmaceuticals, biotech, and materials. They also overweighted transportation, which had a negative effect, and they underweighted some of the better performing sectors. Over the past year, they continue to struggle. As you can see, they've underperformed the MSCI EFA, and they are below the median of the of the international value managers, median value managers. You look at the longer term basis, though, you can see this manager on a long-term basis is at or right around median. And with the exception of I think that's the 3-year rolling period, they actually have outperformed the MSCI EFA. But they are on watch per your policy for the 2-year period as of December 31st. You can turn to page 25. Here, the next segment is your emerging market equity. As I mentioned in the beginning of the report, emerging markets was a very tough area to be in the fourth quarter, as well as over the past years. You can see that here on a relative basis, though, DFA performed well in a tough market at a positive 0.56 versus the index at a negative 1.31, ranked very well at 22nd. And over the past year, DFA has done an excellent job, 13.04 versus a negative 2.54 for that segment, and 10th. So they've done very well. DFA goes in and out of favor. As you can see, the longer term numbers are more challenged, but over the past year, they have delivered in that segment. Invesco Emerging Markets Equity is a manager that is on watch for performance. The largest reasons for their underperformance in the fourth quarter of the year was their stock selection and financials, their overweight and stock selection in healthcare, and the stock selection as well as their underweight in information technology. So Invesco, which is one of your managers, has been challenged over the past year, and that's affecting their 3-year numbers there. The 5-year numbers are more competitive versus their peer group as well as the benchmark. 3-year numbers actually competitive versus the index, but not versus their peers. And their long-term returns, they have beat their inception returns. They have beat the emerging markets index, but are below the median of their peer group.
So Jeff and Gwilda, when we look at these two, especially in emerging market equity, we look at DFA, who has like 20 million, and Invesco has 33. But obviously, again, in my tenure, we've never had a recommendation to be like, hey, we looked at these two managers, and we should move 5 million, 7 million from one manager A to manager B because the stylistic is better. Or we've never had that. And is that something that's common? Because I mean, when I look at a DFA, while they have, 3-year, they were a little bit below, but I mean, they've done pretty well compared to, well, I mean, I would say Invesco in the 5-year, 3 to 5 year, they were good. I mean, it's only been, last year that, they were in the negative returns.
Yeah.
But is that something too that you'll look at and recommend from us? And
what we will look at is typically what I look at is style neutrality. You want you want the yin and the yang, you want a value and a growth component. And we'll look at how these managers correlate, how much alike or unalike they are. So we typically try to structure in each segment of the portfolio, each asset class, so that the return is smoothed out. So if you've got a value and a growth manager, they don't perform in concert. They perform differently from each other depending on the market environment. So we'll be looking at that. When we look at the manager structure, we'll be looking at that as well.
Okay. Right, because you don't want two of the same.
The same thing, exactly.
Right.
We don't want duplication, exactly. Exponence has been with you just over a year. We met with them actually, and as you can see, this time they're slightly off at 5.65 versus their benchmark at 7.77. Just slightly below median. The manager was just hired in September of last year. As discussed during the last meeting, they have made a change in the applied research portfolio. They're moving that into another manager, Redwood, because of a PM leaving in the month of December, albeit applied research did come out with a quarterly return of above the benchmark, but the December number was very weak. So they must have had a very good October and November. But I think this manager is really too early, or this manager is really too early for us to really start making any kind of decisions on. We need to see how this is going to play out. And they've got the portfolio structured, these different managers that perform differently in different market environments to try to smooth out the overall return for this particular portfolio.
So which one is the new manager?
They haven't put them in yet. They actually have. It's gonna the one that says applied research. They're going to transition that to Redwood.
Okay,
Yeah. So that should take place within the next month.
got it.
Our understanding. Okay. So you can turn to the next page. I want to give us some time for the flash report. On this page, fixed income, I would say here that none of the fixed income managers are on probation. Jeff does have a note on Manulife we're going to talk about. But if you look at this, fixed income's returns were really tough in the fourth quarter. As you can see, all the managers were negative in the fourth quarter, negative to flat. Manulife at just a negative 0.03. You just see the Barclays Ag at 0.01. Ernest Partners was off a little bit in the fourth quarter at negative 0.12, ranked 77. Exponents, Jeff and I are going to look at the benchmark for this because Exponents is a little different. They have some core components, but they take a lot of bets in different areas, and it's a very unique and very niche type strategy. So as you can see here, you can look at the numbers for the past year. You look at Manulife and Ernest Partners, they look closer to the Bloomberg Barclays aggregate in their returns. All the managers ranked very well over the past year. As you can see here, that on a relative basis, albeit negative, they're all significantly above their peer group median, as well as above what the Barclays aggregate would have given you. You look at Exponents, that was 8.1%. And I had to call them and say, is this a mistake? But it's because of the way they invest. And I think they're a good diversifier in what you have in a lineup as just typical other core managers. And if you look at the combination of your three managers in that area, if you look at the roll up at the core fixed income and the gray bar across the top, as you can see on except for the quarter, for all the other periods, this combination of managers has delivered over and above the benchmark, and as well it's significantly above the median of core fixed income managers. So that segment combination is actually doing very well.
So, well, this Exponents one is the old Piedmont.
It's the old Piedmont, yes.
It's the old Piedmont.
Yeah, that's the old Piedmont Advisors out of Durham, North Carolina. In the absolute return segment, you've got Lumen Sales, Alpha Trust. As you can see, their numbers were slightly below the benchmark, the 3-month LIBOR +3 in the fourth quarter of the year. This has hurt their 1-year number at a rank, but similar to the median at 1.88. They have not been with you but a few years. The 3-year number is above the benchmark, 5.9 versus 4.32. What I would say here, they had exposure to emerging markets, and that really hurt their performance. Also, the duration bet also hurt them in the fixed income portion of this portfolio, and that's why you're seeing the negative return here in the fourth quarter of the year. The TIPS is another index fund, so that's mimicking what the Bloomberg US TIPS index would do. If you could turn to the next page, Sue. You've got your global multi-sector. The first manager here is on watch, Neuberger Berman, continues to be challenged in the fourth quarter of the year. They had the detractors for their performance in the fourth quarter was their exposure to some of the emerging markets and some of their weighting in the sovereign debt area. As you can see here, they were negative and slightly below the median manager. So tough market, as you can see here, for these types of fixed income managers. They rank 55th, and both them and the other manager, the median manager is a negative 0.24. Over the past year, this portfolio has also struggled, and I'm sure it's due to their weighting in the sectors that I mentioned already. As you see, it's 63rd, but the median manager, 63rd versus median manager, so they fell below that median in that time period. We go down to the AMD blended Lazard here. They are not on watch. And as you can see here, albeit a negative return relative to other managers that manage like them, they were above that, ranking at 44th. Over the past year, they have actually outperformed the blended benchmark, and they are doing better than the median manager. The negative 1.14 versus a negative 2.05. These are relative returns. I know they're negative, but they protected you in what was a difficult market, and they did better than the average manager in that segment, ranking 34th. In the next section, the manager that is on watch is a GMO Global Asset Allocation Manager. They continue to underperform in the fourth quarter, a positive return, but not as well as their benchmark. 1.82 versus 5.05. As far as their rank versus other managers that manage like them, they ranked 77. They had their asset allocation decisioning and positioning in the emerging markets equities area hurt them as well. And also security selection in the fourth quarter. In their portfolio, 13.4% was in emerging markets, so that did not help them at all. And then had another 4.1% in emerging markets, ex-China. Also, some of the security selection hurt them. So that they've had some security selection as well as where they decided to allocate that hurt them in the fourth quarter of the year, which has also brought down their one-year number. This manager is struggling, as you can see, on a 3-year, 5-year, and since inception basis. So this is something we will continue to, Jeff and I will continue to monitor going forward.
So Gwilda, I'll give you and Jeff a little background on there. The GMO and the TAA and the GAA is what we used to use when we were dipping our toes in emerging market and getting into some different asset classes. So this has been around, I would say, since I've been around this. I was on the board when we hired this, but it was to give us a little more global comfort before we dove into emerging markets. And we never pulled this section back, right? We went into emerging markets and we never pulled it back. And so again, this is one where I don't think that we need, given how diversified we are.
Yeah.
Because we've got the PIMCO all asset, and every board member will tell you here, we are so generous that when we get an allocation, we like both managers. We like the stories within 30 minutes, and we're like, oh, let's just split the allocation into 2 or 3 managers, and we do it. And then that's why we end up having all these different managers.
Oh, okay.
So, or NEPC would recommend 3 managers and saying, this is a, these 3 complement each other. And so therefore, one's a quantitative, one's a qualitative, and one's just a blend. So you can't go wrong with all 3, right? So look at that one and see if we really need GMO anymore.
Right. I was going to say PIMCO. PIMCO's done well.
Yeah. We used to have 2 PIMCO portfolios, and we ended up keeping this one. We had an all asset and an all income fund, I believe, Sue, but we kept the all asset one, just like we've been trying to get out of the 2 UBS portfolios for a long time. We wanted to keep one, and never got out of the other one because we were jumping to private equity all the time. So I just say, look at that one and see if this is one that, may be better reallocating of assets.
Okay. We'll do
Last
that.
year, in this category, we had the Mellon Fund.
Okay.
We took those assets and we split them between the 2 managers. I think there were some concerns about litigation with PIMCO. So I don't know if you all have any updates on that.
We'll have to look into that. Jackie.
Well, PIMCO years ago, right? We had them on watch list for a long time because Gross left. and then his successor left.
Oh, yeah,
Yeah,
okay.
yeah. So that was why
wow.
we had them on watch list, but I don't, oh gosh, I can't, that's been a while. I don't remember what the last one was on PIMCO.
Yeah, I think there was some litigation in this, so there was concern until that kind of went away. Not necessarily giving them the whole asset allocation
Okay,
from this space.
we'll look at that. Okay, then you've got here, well, I talked about the PIMCO asset fund. Then you've got your total hedge fund here. Actually, you can see here the hedge fund portfolio as a whole has done well for the quarter as well as over the past year. It has added value over and above the HRFI composite index. Jeff has an update on the interest, and we brought that up at the last meeting, but as you can see here for the quarter, all of the managers have exceeded their respective benchmarks in the hedge fund portfolio. And Jeff's going to make mention regarding interest on in his portion of the presentation. And then the next page, page 28, is the real estate portion of the fund. As you can see here, the Trumbull funds reported. Big Real Estate and Elm Tree have not reported their fourth quarter numbers yet. That's why you're seeing 0 there. That's not an accurate return. And once we get those numbers, we will report them to you. The Trumbull funds, as Christina mentioned, they have had difficulty over the last several years. They've had a huge exit queue. I actually was on a call with them recently regarding their performance. They allocated in the wrong places. They were in retail and office. Over allocation compared to the Odyssey, their benchmark. And as you know, those areas both suffered, especially during the pandemic. They have started reallocating, and they said 2021 was a year for them to start recovering and reallocating their assets. So they have brought down their numbers in both of those segments that have not done well. They are now multifamily or apartment and industrials is where you will see overweights in those two funds currently. I don't know, did you all put forward, we didn't ask this, are you in the distribution queue or where were you with respect to the two Trumbull funds?
I recall that we were going to get out of the property fund.
Okay.
And we were going to consider what we were going to do on the income fund. But we used to have higher numbers to both of these, and we redistributed some other numbers. But again, it was my goal was to get out of the property fund, but we just never pulled the trigger because something always came up, and then we just kept putting it on the back burner.
So did you actually put forth a distribution request?
No, I don't think we did, Sue. I don't think we did.
This is going to be one that's going to take a while to recover. And we can look at that and see if you want to get in the distribution queue. They have distributed quite a bit of money over the past year, but it's still a huge queue. And you're not the only fund. There are a lot of funds that are in this Trumbull property fund that are in the same boat that you're in with respect to them. So,
well, since we don't know what that means, can you explain that?
Okay. When in these private real estate things, you can't just come out like you would in a public equity portfolio, whatever. There's a queue. What they call a queue is it's an entry queue. If you want to buy in, you can't just buy in immediately unless they have no entry queue. And you can't just come out when you want to come out. You have to get in line, basically, and it's on a first come, first serve basis. Say, okay, and they cannot compromise the returns of the whole fund by pulling too much out. So they pretty much just say, okay, we can distribute X amount to you over time. We can give you this much now, until you finally come all the way out. But what you have to do, you have to put in a request. And that's where you get in line. You have to put in a request to say, okay, we want to come out of this fund. And then they will tell you, this is the schedule to get you out of the fund.
Oh, I don't think I knew that. Did you know that, Sue?
I'm not aware of anything.
Jeff, have you had any experience trying to get out of, have you have any clients that are in trouble that are trying to get out?
I I have clients that have been in the queue for probably 5 years now.
Yeah. Yeah.
So, yeah, so that's the process. And as Gwilda said, it's really, it's designed to not not impair the remaining investors, because of the only way they can really get money today and to get everybody out, they would have to sell a bunch of properties, and they would have to sell them at fire sale type discounts. And that they just, from a fiduciary standpoint, can't do that. So that's why their documents allow them to do what they've done, which is suspend and pare out redemptions over time. Now, usually what happens with a lot of these funds is the environment changes, and we have started to see that now, that the commercial real estate market for the properties that UBS is in has become, it's gotten a lot better, as you can see by the numbers. So the past couple of years through COVID and the pandemic, there was a lot of softness in those numbers, and so those queues kept going up. Now, as the market's gotten better, some of their investors have said, well, we're going to rescind our redemption, and they've also had new investors coming into the fund. So when they're in that kind of position, they then have excess liquidity that they can use rather than selling properties to pay out investors. So, but that's really, unless there's something that they've had for sale in the portfolio and it liquidates today, the only other way they're going to be able to pay out investors is with new money coming in. So that's the process that they evaluate on an ongoing basis. But it's been slow, and they've had this queue for a while, and it really started several years back based on not only performance issues and underperformance, but then following that they had a number of significant team changes as well. So all of those really led to this buildup investors trying to get out of the fund.
Okay. The only other thing I had, and I know hopefully we can go over, because Jeff hasn't had a chance to go over your most recent stuff, is page 83. If you can flip to that very, very quickly, Sue, so they can get an idea of what we're going to do on a quarterly basis with respect to, it's near the very end of the report, what we're going to do on a quarterly basis, because I don't think you've ever had an outline of your full private, this is a private market reporting, where we're going to list here the vintage year, the year that you invested, how much you invested with each one of your alternatives managers, how much is left that has not been called or they have not asked you for, that's the remaining balance. We show the drawdown amount, which is what has already been called. The distributed amount is the amount that they have sent you back, and the market value. And then it talks about the internal rate of return for each of these managers, as well as the total value and principal multiple. Now flip to the next page. I think we have, no, we don't have it. Okay, go back. So what we're going to do is, what we'll eventually do is we will have as you can see, there's a composite return. The internal rate of return for the private equity, as you're looking at next to the last column, has been 10.9. That's through September. And then you've got the private debt portfolio through September has returned 11.43. And for the two managers, this is not including the Trumbull, you see the big real estate and the Elm Tree through the real estate composite does include those. As you can see, the real estate composite returns. So we're going to give you a more detailed report on your privates. I think before you only get one roundup or composite of your alternatives, but we're going to give you a more detailed report going forward. And these will always be lagged by 1 quarter because they always 3 months behind typically in the reporting. And that.
So, Gwilda, have you ever seen our private markets report that we used to get?
We have not received a copy, and we had to compile everything from scratch.
Sue, can you send Gwilda?
It should have been in the fourth quarter report. It should have been in there. It's not a separate report. It should be in there.
Okay, we'll look for it, but I know my group, they were saying they're going to have to go back to inception to find these numbers. Okay. So that was my part. I hopefully we have a few more minutes so Jeff can go through his part. But thank you all for your attention as well as your questions, and we will address those questions that you've asked that we weren't able to answer this evening. Thank you so much. Jeff?
Great. So I'll try to be sensitive to everyone's time here, and I'll be brief on everything. But Sue, if you want to pull up the flash report.
Okay.
And Gwilda gave a great overview of the managers and things we're thinking about. So I won't have to spend a whole lot of time here other than probably give a little bit of a depressing update. So if you, Sue, if you want to flip over to the second page.
I'll beat you, Jeff. Everything's negative.
That concludes my report. So, if you can flip forward one more, Sue. Okay, and so as Christina summarized very nicely there, everything is negative, and I briefly mentioned before that there's really a number of headwinds that we've been facing, and we even talked a little bit about this at our last meeting because we were through a good portion of January already to see what was happening, and it was really a handful of things. Number one, the continued pandemic and Omicron and everything that's really created as far as overall market confidence. Number two was that inflation number, and that most recent number coming in at 7.5%. That's significantly above what the Fed targets. The Fed targets inflation at around 2%. So that's what the world expects. And when we have a very large number like that, that's disconcerting. Everyone says things are very expensive. That starts to impact the consumer at the gas pump or at the store, and consumers start to pull back their spending because of that. And the Fed comes in and says, well, maybe we have to raise interest rates to combat that. And that really, in a short-term basis, hits a lot of the markets, as you've seen here. It hits the equity markets, fixed income on the next page. We won't flip over there at this point, but really there was very few places to hide. Also throw in some of the more recent volatility now that we've seen from this potential conflict between Russia and Ukraine. Again, what that ultimately means to certain factions of the economy, I think remains to be seen, but it's a news item, and markets trade on news items. So but throw into the mix as well some of the growth and technology type stocks that did very well during the pandemic got really expensive. If you think of Apple and Microsoft and all these names that we know very well, and things that really helped us get through the pandemic, well, they got expensive. And so again, when markets start to get nervous, they sell off in a very big way those most expensive things. So alternatively, anybody who's remaining in the market is now starting to look for things that are cheap and values. And so if you look at this first column for the month and take a look at the large cap value and Edgar Lomax and their benchmarks. Edgar Lomax did it extremely well. They're positive in relative to a market that was negative 2%. But then you go down a couple of lines and you look at Intech and Russell 1000 growth. So the index itself did a lot worse growth relative to value, and then Intech underperformed as well. So again, Gwilda talked to you about the quantitative or the watch list just based on those return factors, and so certainly something we want to keep an eye on. Also wanted to talk about a news item, and that's that Intech, who has been owned by a larger organization, Janus Henderson, Intech is going to take that back to private for the group that manages Intech. So they're going to actually own the firm now. So Janus Henderson essentially selling it to all of the key individuals that run the Intech funds. So we still have to absorb what all that means, but it's just another watch list item. It's a pretty meaningful organizational change. I think in a lot of cases, when you see a management buyout of a firm, it generally might mean good things down the road because it's more focused. The people that actually run the portfolios in the organization, they now have a very large stake in the potential success of the business. And so all of those are good things. However, you throw into the mix some of the news that surrounded this of saying, well, Janus Henderson is getting rid of a unit that's not good, that hasn't been performing well, and they want to get out while the getting's good. So that's the other side of the equation that we look at on that just says, in addition to the fact that their performance has been lagging, they also have a pretty big ticket news item and organizational change that warrants them being on watch. So as part of that, and this is something that will be an action item for this committee, is because of that change in ownership, ultimately that means they have to assign their investment management contract over to this new management group. And so that it just based on your existing agreement with them says, if they want to assign their investment management agreement, that has to be approved by the board. So our recommendation, and again, let me say the alternative is if everyone decides that you don't want to assign it, then the alternative would be you'd be in a position that you would have to terminate, or not immediately, but in fairly short order, and liquidate the portfolio and transfer the assets somewhere else in the portfolio. So our recommendation would be to go ahead and accept the assignment of the contract. In the meantime, while we continue to watch the manager and determine over the next couple of quarters what we ultimately want to do with this manager.
I'm sorry, Jeff, I stepped away for a moment to, which manager?
This is Intech.
Oh,
So,
okay.
yeah, so just quick, high level, their management group is buying the firm back from Janus Henderson. So again, we'll need some time to absorb what that is all going to mean, if it ends up being long-term good or long-term bad, but add that into the mix of the discussion that Gwelda had regarding their near-term performance, which has not been great. So just another factor to add on why this manager should be on watch. But as part of that, because they are changing the overall management structure of the group, that their current contract with the system has to be assigned to this new group. So otherwise, if you choose not to assign it, then you would be in a position that you're basically in conflict with your agreement and policy and so on and so forth. So again, our recommendation would be to go ahead and accept the assignment for the time being, and then continue to monitor the manager on watch until we determine ultimately if we want to keep them or if we want to look towards replacing the manager.
I think that requires a board vote.
Well, yes, because it needs action. We need to get a board approval for, and then Sue, correct me, we have to, since this is an investment committee, we have to take a vote today for that to accept the assignment of the contract. And then does it have to go to the full board?
Correct.
It would have to go to the full board before we can.
So we'll do that. I mean, that'll be within the deadline because that board meeting is the 28th. I think this is mid-March that they were looking for the letter. So we're fine on time.
Okay. I just wanted
my question is, where is this in the report?
It's in our guidelines. So in our guidelines, we have specific guidelines that say a manager will be put on watch list for change of management, sale, owners, so it gives us 4 categories, I think it does, in our guidelines. So it gives us the ability Doris, to reevaluate when there is a serious change at the top level. Or, for example, if a manager says, I'm large cap, and then they say they're moving more into mid cap, then that would be a change in style. And so that would be a reason why we would also put them on watch list or bring them in if they're changing the guidelines that under what we hired them for.
Okay.
So for example, those are some of the reasons why we would put them on watch outside of performance.
Okay. I just need to have a copy of the guidelines.
The guidelines are on the website. So your
Interesting.
guidelines are in your website, and they're also in the book that you received.
Yeah. No
but
problem.
in there.
No problem, Christine.
And if you text me, I will tell you exactly what page that is on the guidelines. give me a few seconds and I'll let you know. But it's good always to ask the question and know where it says. But give me a moment, but go ahead, Jeff, I'm sorry.
Oh, no, and I was just gonna say for Doris too, with respect to this actual recommendation that we're making today for assigning the contract, there is correspondence directly from the manager, and I know Sue has that on file and she can share that with the committee as well. But again, this was a correspondence that came to us from Intech, again, explaining the change in management of the company and their need based on their contract to have that contract assigned. So
Yeah, and that Intech document was sent out with a meeting invitation.
So Doris, so if something like this happens, usually Sue, the consultant, will give us a memo, a letter from the company, and then Sue will send it out to us. And then we'll discuss it at a meeting and either take an action or an inaction for it.
Thank you. I'm reading it right now.
So the recommendation from Jeff, from ANCO is to accept the reassignment
correct.
at the moment, and then we can go from there, depending on what happens in the next couple quarters, since they're on the watch list.
Yes, sir.
Do we need to make a motion, Christine or Susan? Sue?
Sue, do you have a motion? Because obviously this one is a double whammy, because isn't this the one that's also on watch list? Is on the
Correct.
watch list for performance.
Yeah, I don't have a motion. But I think if we could just phrase what, Jeff, if you want to phrase what you recommended again, I think we can use that for our motion.
Sure. So our motion would be to accept the assignment of the Intech contract to the new management group for Intech.
Before we make the motion, the other option would be to say no and then figure out how to get out of it or reallocate the funds to another, someone else.
Correct. That would be the alternative. If we choose not to assign, then ultimately when they do finalize their change in ownership, we would be out of compliance with our current contract with them. So that would really necessitate, we would have to terminate.
Which we could still do at a later date, right, Jeff?
Mhm.
Sure.
Are we ready for the motion?
Yes.
If I mess up, let me know. I make a motion to accept the recommendation that we reassign Intech to their new management group due to change in ownership.
Second.
It's been properly moved and second. Is there a discussion? Hearing none. Sue, can I get a roll call vote, please?
Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Sorry, there. Yes.
okay, Donna Jones,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Justin Stein,
Yes.
and Doris Walker.
Yes.
Okay, so we have 9, so the motion carries.
Thank you. And so Doris, I'm going to refer to you to section 6 of the investment guidelines, standards of investment performance. And that will tell you that managers will be deemed to have performed satisfactorily when compared with the objectives set and other similar. And then in addition, progress, continued appropriation. So those are, and then also what puts managers right after that on a watch list. So
Thank you.
section 6 and 7 of the guidelines.
Thank you.
Jeff, do you have anything else?
Right. No, if there's another question about Intech, again, I won't spend any more time on this. We sort of see the top line numbers. Gwilda gave us a good idea of what's going on with a number of the underlying pieces. I guess the only other thing I'd point out is even with a month that had some pretty nasty negatives in certain categories, you can see from a top line perspective, not only it is being down at only about 2.5% and actually being better than the policy index, that still keeps those longer term numbers in a very good position relative to the benchmark and the actuarial return assumption. And I think is just a good, again, a good reminder of the overall structure that when you have a very thoughtfully diversified portfolio that operates well and continues to provide certain protections in these volatile markets, this is exactly what it's designed to do. Again, there's certain things we want to look at and we want to tweak and get more efficient and do good things. But again, a good month to sort of let us know that you really have a good level of diversification, not only across your asset classes, but those managers within those asset classes.
Mhm.
So, and then the other two things on a housekeeping note, I'll just make really quick. Again, Gwilda mentioned it, Manulife. We received some notification from Manulife that one of their individuals that's been an analyst, they've promoted up to a portfolio management role. So again, this is just a news FYI. We think that's good. We always like when these firms are promoting within and adding to the structure and the voices that are on a portfolio management committee. So all in, that's a good news thing to get. We like getting good news from managers on organizational updates. So that's really a no action item. And then the second item was Entrust. So I know we talked about that Entrust position at the last meeting and noting that the only thing really left in there was this very illiquid Peruvian debt position. We went back to Entrust and also talked to our research group who had reached out to a number of different factions that we deal with to see if is there liquidity for this Peruvian bond position? Is there liquidity for an actual share of Entrust? And I guess the long story short on that is there really isn't. So, and we also had correspondence again that we got back from Entrust because we asked them that question, said, is there any possibility of selling our Entrust share to somebody else? And they came back and said, well, again, the way this is structured is we'd have to find liquidity for the Peruvian bond. Otherwise, if there were any buyer for the position itself, it would be at such a steep discount that we just don't recommend it, and it's just not a road that we want to go down. So that's sort of what they came back to us for, and I think that's where we are relative to the last conversation, is to say we really have to rely on the manager, and the manager's view is that they think that while arbitration might go on for a while, that they believe there is value to be garnered from this position over the long term. So we may have to wait for it, but again, we would really have to defer to the manager and their expertise and their recommendation of saying they still think there's value to be garnered from this position, and it would not be a good idea to fire sale the position.
And when does the bond mature?
The bonds don't, they've got a very long maturity date on them. I don't have the exact date, but I guess the fact is, and why we're in this position right now, is that the government's been defaulting on them for quite a while on the interest payments. So that's why ultimately this has gone into arbitration, because the hedge fund manager came in and said, well, you've been defaulting on it, so we want full payment of the position today. And the government basically said, well, A, we're not going to continue paying you interest, and B, we're not going to pay you the principal on this. And so it's been at a real stalemate. So that's why this has gone into arbitration on a global basis.
Thanks. So I guess the question for me is, what value? I mean, we are at, where are we? How much is it? 1.5 million or?
Right, 1.5 million, correct.
Yeah. So does it make sense to take that off as a write-off and just recapture it at some point? I mean, instead of showing a negative number every single month on our flash report? Or again, Sue, that's your question more than anything with the auditors.
Yeah, that's something we'll talk with them. They'll be here in a few weeks. And so we will discuss that with them and get their thoughts on it.
Okay, thanks. Hold on, let me tell someone to be quiet. Hold on.
I would like to say while she's telling somebody to be quiet, I think I learned, I've been on the board for 2 years. I think I learned so much more today with this end of the year report. Not much more, but I learned a lot today than I learned in the last 2 years. Maybe I wasn't paying as much attention, but I think, honestly, I think the explanation though from ANCO was very, it brought it down to, I guess, my pre-K level. I teach pre-K, but it helped me understand it.
We try to make sure that our boards understand what we're talking about. I know sometimes we have a tendency, and I have to catch myself using the industry lingo, but please correct me when I do that. I have, but we try to make sure that when we present that the boards understand what we're talking about and bring it down to what's relatable.
And well, just so you know, I do ask a lot of questions. Not so much for my benefit, but for the benefit of the board, because, again, this has been, the industry that I've been in for so long. Right. So for you and me, we could have a conversation and be fine, but not everybody understands some of the numbers and how they're presented. And so my goal, again, with our board chair Lewis's goal and those that are, and Sheila that's been around for a long time, is the really educational component to better understand our reports and be able to repeat or even explain sometimes if someone asks us what's going on our board. So I thank you for your patience. We do not necessarily have a strict hard deadline. If we know that the meeting's going to be long, we turn around and ask our trustees to be patient with us, but we will never cut you off at 6. So just so you know that.
Okay. All right. No, and I appreciate the questions. And, like I said, don't be afraid to ask the questions. I know sometimes you're hesitant. And even after we get off the call, there's something you don't understand. You have my number, you have my email. Please feel free to reach out to Jeff or I regarding something you may or may not understand in the report or otherwise with respect to investments. The only other thing that I had is Fairview. I know that you committed to them in the fall of last year, and we did write a memo which Sue will share with you if she hasn't already shared it with you. But basically, our research group on the Fairview Fund 6, we don't have any concerns about you guys going forward with making that commitment and depositing those funds with Fairview.
Oh, good. So we don't need a motion for that because we've already approved
done it. Yeah, you just asked us to give our opinion on it.
Yeah, that's the last one that's still pending. We just closed with the big real estate fund 2 last month. So this is the last one that's still pending from that group that was approved last fall. So their closing is in mid-March sometime.
Okay, so I guess we can just move forward with that. You'll contact Fairview?
Yeah, they're our legal folks are working with them right now on the side letter and the other documents. So yeah, we'll be ready to go.
Okay, and then can you share with the letter with Gwilda that Matt always likes to get our managers to sign to get their opinion, because I know that's been the holdup sometimes, that Matt takes his interpretation, and rightfully so, to be able to protect us, but to let Gwilda and Jeff and their legal team give us an opinion of if when to use that, and when they believe we can get it, and when we don't believe we're going to get it based on their relationships with certain managers.
Okay, certainly.
Well, offline, you guys can talk about and bring up to speed on that. But we don't want to get to, March and then have to have an emergency meeting again because of this letter. And Sue will explain all that. But we've had that in the past where we have to make the decision of, we've done it in the past. When we can get it, we get it. And when we can't, we were comfortable not getting it.
Yeah. And I think legal has that marching orders now that if they don't get their exact language, they're still going to move forward on it.
Okay.
But yes, I will share this with ANCO.
Thank you.
If there's nothing else on the agenda, we're not going to even begin the investment guidelines discussion today. We'll table that to the next meeting. If there are no other, hold on, don't leave. If there are any other questions or concerns, if not, I will get a.
With the watch list, do they just go on a watch list, or do we have to approve? Do we have to do a motion or anything for that?
They automatically go
They
on.
go on it. Mhm.
Okay. Well, I'll make a motion to end the investment committee today, February 1st? No, February
17.
17th. I mean,
Second, Richardson second.
All those in favor?
Aye.
Aye.
We'll see you next month, everyone.
All right.
Okay, thank you.
Take
Take
care.
care.
Okay.
Aye. Thanks, everybody.
Bye-bye. Thanks.
Bye.